Hello, I'm Bob Kendall. In this series, I'm going to be going through a lot of the indicators that we just released. I'm going to start with the PPMs. And before getting into a lot of detail on how to use them, I think it's important that you have an understanding of the philosophies and some of the concepts that we developed. I'm going to do this video in three different parts. One is going to be philosophy and origin. Two is going to be the construct, or how they look and what to expect from them and what they track. And then the third one will be talking about something that is really important to understand, which is angle of attack, or AOA. It is an aviation concept that actually applies to the markets better than you think it will, both negative AOA as well as positive AOA. And I'm going to make this first video very brief, just so you have these understandings, you understand the probabilities and some of the concepts. Let's get into that. In this section, I'm going to be discussing the philosophy and the origin of the PPMs. This is an interesting story. It goes back to 1984, and I was working with a client of mine who was an ex-professor at University of Michigan, and Bill and I worked together looking at a couple things. We were trying to solve an issue we were coming up with. We were attempting to determine when they were a valid trend line. Otherwise, if it was an upsloping trend, that the market would trade down to it and hold and then bounce back and keep going in the direction of the trend. And then the same thing on the downside. So we started looking at this. How are we going to figure this out? So we decided to go in and study the moving average itself, its percent change, first and second derivatives, and we started to break down probabilities. So the big issue that we were trying to solve is that value going to hold or not? The second issue that we had to solve was which moving average. So we were using the 21 period moving average. It was a Fibonacci number. We had gotten into Elliott wave at that time and started to study Elliott wave sequences. So we continued to develop those concepts around the 21. And then we realized there was a shorter term trend and a longer term trend within a trend. So this is where we came up with a number of concepts. And this is why there's PPM 1, 2, and 3, because we started to realize that there was a short term element, a primary element, and a longer term element that set everything up. Something I'll go into in a later video series is WaveTech itself, which is actually utilizing moving averages to confirm wave counts and determine what the probabilities were of that wave continuing. And this was all done through the PPMs. So the origins go back to 1984. We continued to develop what moving averages we wanted to look at, and that was the basis for everything. In the next section, I'm going to go through exactly some of the things that we found out and which moving averages we came up with. In this next section, I'm going to be discussing which moving averages that we ended up using, as well as taking a quick look at the PPMs, including starting to get into the factors of understanding the angle of attack and what it means to trend analysis. For the most part of what the PPMs are for, they're multiple use indicators. Number one, they are to identify upward slopes and moving averages. And I'm going to show you a probability map here in a minute that tells you what the values mean. When I talk about 0.25 and trend level and different elements, I'm going to go through that just to show you exactly what that means to the moving average and how you can interpret them. Also, I'm going to discuss when the first and second derivatives get taken out, what that means from the analysis standpoint and from a trading standpoint. Let's get into it. All right, let's dig into the moving averages to start with. One of the reasons that we chose the moving averages ultimately was not necessarily just about the trends, but it was also about utilizing Elliott wave. As I mentioned earlier, the WaveTech methodology is about using moving averages to confirm the wave counts and therefore helping you to have a higher accuracy in where you are in a particular sequence. But regardless of that, it also identifies strengths in the trends and probabilities for things to continue. I'll go into the probabilities in the next section, but for now we're going to stick with just the moving averages. So I use 3 moving averages, the 10 period, the 21 period, and the 40. If you recall, initially we used the 21 period moving average just because it was a Fibonacci number, but we also found that it had a lot of characteristics that we talked about, and I will go into more details in other videos exactly what those characteristics are, but primarily the 21 period moving average ends up to be the primary demand line on the upside, and on the downside it's the supply line, or otherwise where the selling is going to come in. It's basically the point in the trend that you want to pay a lot of attention to. So therefore, a lot of focus does go to PPM2, which tracks that moving average. Now you notice on the PPMs, as you look at them on this screen, is they have 2 different elements. They have a first and second derivative, and this helps to determine when certain events going to happen. Now this video is going to be too short for me to go into a lot of detail, but I am going to show you a couple things. Let's go into a full screen so you can see some of these details. So as we look at the chart, you'll see a couple things. I'm going to draw a sequence down here that shows where the downtrend started. And you're going to notice here that PPM1 broke down, crossed through its first and second derivatives, and simultaneously the PPM2 did the same thing. And then ultimately PPM3 actually had crossed way back here when this trend flattened out here. So there was a number of things going on, and I've also included on this chart the PPM 200 or the WaveTech 200, which tracks the 200 period moving average, which is this average right here. So what's happening as far as the overall sequence goes, these declines in the PPMs were confirming the strength of the downtrend. And the first cycle, which is typically not always how it happens, but in this particular cycle, this is a short-term daily chart, this is where this happens. If we start to draw lines just vertical up here, you'll start to see market events. We had virtually the same event happen on PPM 1 and 2. If we come over here, you'll see that this is where the longer term trend flattened out, and this would be the blue line here. And basically there was no more long-term upward momentum, but there was enough relative momentum to set up a pattern, which there's a lot of details which I'll go through. My plan is to do a master class on this, but there's one other event I want to show you here, and this is when we saw this final breakdown over here, which set up the decline, but something else happened. The overall trend in this market, now this is current trend while I'm doing this in March of 2022, this is where the trend is, this channel that's coming down right now, and you can see that we're starting to see some noise, but they're still negative on the PPMs, but they are trying to turn up, which suggests that there's possibility of some stability in the market. So like I said, in the next segment, I'll go through some other ideas here, but this is the basic concepts that we're looking at. So we chose the 10, 21, 40 period moving average, as the 21 is what I call the primary demand line or supply line in the case of the market going down, and on market going up, it's the support line. And we'll go through a lot of those details in the training that I'll do in the live room. In this final section, we're going to be going through a couple more techniques and ideas on the PPMs and how to use them, but I'm also going to go through some detail in understanding the angle of attack, which has everything to do with trend analysis, and ultimately down the road when I go through the WaveTech concept to understand exactly how the angle of attack plays into the impulse waves as well as the corrective waves in L8 wave, and then they also play into the ability for trade setups and a lot more. Let's get into it. In this section, we're going to start with the angle of attack. I talk about this all the time, and I want you to understand that these PPMs are measuring this angle of attack, and it's measuring it on 3 levels. The PPM 1 is looking at the 10-period moving average, or the short-term element of the trend. PPM 2 is tracking the 21-period moving average, looking at the primary trend, or that demand line that I talked about. And PPM 3 is tracking the 40-day moving average, and that sets up the longer-term demand in the trend. And typically what happens, if we were just to bring in WaveTech for a minute, is that the strongest part of the trend is wave 3. That's when we'll be above the 10. The 21 and 40 period averages are always simple, and I'll explain that in a later video or in the live room. Those represent what the underlying trend is doing and the continuation of that attack, or ultimately you see here where it starts to roll over. Those longer term averages will be support levels, most likely from an Elliott wave viewpoint. They will represent even wave 2s or 4s in a corrective sequence and define where the final sequence to the upside will be. And there'll start to be lots of divergences from the standpoint of how the PPM set up. So this basically scale that's on here is showing you that the more that the PPM is up in value, the probabilities are going up that it will hold that value. The inverse is true if this was a downward sloping or a downward angle of attack, then they would have negative values. The probabilities would suggest the likelihood of the market rising above those averages. That will be represented on the scale on the bottom. So once you get to a certain point, probabilities will go as high as 90%, suggesting that the value of the current trade will not decline below that value, and specifically will not close below it if you're above 0.25 and 0.50. There's a very small likelihood. On the inverse, on a downtrend, if they're negative numbers, then we're likely to hold below that number and not close below those values. Let's take a look at some charts and get an idea on how this works. So let's take a look at this chart and where the uptrend is starting here. And you'll notice that the PPM 1 is the first to cross over. And when it does cross over its first and second derivative, it starts to suggest that that 10-period moving average will start to advance. And initially, you'll get a boost in here. And I talk about this all the time, that momentum precedes price. And let me draw in a couple things that I'm going to go across the board as I discuss this concept. So here's the crossover point, and we get the ramp up of value. We get well above 0.50, and you see that the 10-period moving average rises. We start to stall, and then what is happening next over here, just shortly after that, we get a confirmation that PPM 2 is turning up, and then ultimately we see an acceleration in PPM 3, and this tells us that we're into this longer term moving average being the primary demand line. So we go from the 21, the center line here was the demand line. We held the 10 throughout this period. We came up to that line, then we went down to the lower line, and then it continued. And this was the section that I was talking about earlier, where we start to see the rollover and start to get the confirmation of these current downtrends. Now, this is a really important concept to understand, because really what you see here is you get into a trend mode and you get all 3 averages rising, and this is that angle of attack. When you get into an angle of attack, that means it's sustainable to a point, and this is a short-term chart, so we can actually carry this action into what I call a multivariant, and we could go in and look at the weekly and see how the trends are developing on the next level. So this basic concept is important. I talked about the downward sequence in the previous segment. So this is exactly how you use these. You look for these turn up points and you start to see the acceleration and the beginning of the trends. If you use my moving average 10, 21, 40, then everything is going to be showing you when the moving averages are crossing and starting to move in a direction. This is really the crux of the basic concepts to utilize these indicators. And as I said, in the live room, I'll be going through much more detail. This will complete this short video. I hope this was helpful and at least getting some basic understanding. If you attend our live sessions that we have on Monday, Wednesday, and Thursday, I will be going over this. Typically, we have Mondays as a trading day and a review day to get the week started. And I'll be going over a lot of these indicators that I use at that time. Wednesday will be a focus on all of the indicators and start to bring them in. It's going to take probably several weeks. And while that's going on, there's going to be more advanced videos coming out about each one of these indicators. Thank you so much for becoming a partner with us and having these indicators. I can't wait to hear the feedback that you folks have and new techniques and things that I never dreamed of that you'll find. Thank you so much. Enjoy.